Hello, today we are going to learn how to create a loan amortization schedule using Excel. This knowledge is useful for bank officers, property agents, and house buyers. You can also use it for personal purpose to give advice to anyone who needs such knowledge. I hope at the end of this educational video, you will be able to create an Excel spreadsheet for yourself too, and even modify it further to suit a variety of loan amount, interest rates, or repayment period. I'm going to make use of an example that is more relevant to our current market situation. This video is created in August 2020. As you know, recently the government has announced a reduction in interest rate to stabilize the economy after the COVID-19 pandemic. Imagine you wish to buy your first home, an apartment in Klang Valley at around 400,000 ringgit, based on current base lending rate of around 5.4% in Malaysia. You are a young fresh graduate who can borrow up to 30 years. I would assume a zero down payment, and you can borrow up to 100% of the property value. The most common questions frequently asked by house buyers are: how much is the monthly installment? How much salary I need to have to afford the loan? Well, we are going to answer these questions at the end of this video by constructing a financial model using Excel. The cell highlighted in yellow represent my important inputs, which are loan amount 400,000, interest rate 5.4%, number of years 30. The very important first step is to calculate the monthly installment. I'm going to make use of the Excel formula equal PMT. PMT means annuity. So I shall type equal PMT open bracket. As you can see, Excel will guide you accordingly with all these little symbol here. Rate is the interest rate. So I point my input here, 5.4%. Just take note that I need to divide by 12 because all interest rate quoted in the market is on per annum basis, but my installment is a monthly installment. So I shall convert this into monthly interest rate, comma. Next, I shall point for the year, and PER means year. So I point 30, but remember I should multiply with 12 because in 30 years, there are 360 months. Next, I type comma, and I shall point the loan amount present value. Okay, type comma, then future value is 0, comma again. I shall type 0 for ordinary annuity. Close bracket. And don't forget, in order to obtain a positive answer, I should put a negative in front of the PMT. Enter, and this is the monthly installment. Now I'm going to create the loan amortization schedule. For the month, I'm going to type 1, 2, 3. Do I need to type until 360? The answer is no. All I need to do is highlight this and drag all the way down. Excel will be able to read the sequence number and generate the number accordingly. I shall drag until 360. Up to here. Alright. The beginning balance is actually equal this input. I just need to point the cell. The interest charge is based on how much you owe the bank. Point the beginning balance times interest rate divide by 12. Remember, fix the reference point for interest rate. I shall type F4 so that the strings appear. It becomes string C, string 4, refers to this cell only. Alright, enter, and I have the interest charge. The monthly installment is equal to the amount that I have just calculated. So I shall type equal, point this cell, put my mouse here and type F4. Fix the reference cell by using the string function. Enter. That is my monthly installment. Principal repayment is equal my beginning principal minus the, oh sorry, this is equal my monthly installment minus the interest charge. All right, so this is the principal repayment. My ending principal is equal beginning principal minus principal repayment. Later, I shall write down the formula for you. All right, this is followed by beginning balance for the second month, which is equal, point this out. So that's all I need to do. I just need to create 1, 2, 3, 4, 5, 6 figure. After that, I put my mouse here, all right, put at the bottom right until I see a cross sign and double click again, point this cell, double click again, and double click. And all the figure will appear automatically. A good way to check whether the model is correct or not is to look at the amount outstanding at the end of the loan period. If the amount you owe the bank is zero at the end of the loan period, the model tends to be correct. Other important information that you can check is interest charge tend to be high at the beginning of the loan period. Principal repayment is relatively lower, but you can see the interest charge will reduce over time. Principal repayment will increase over time. This is because the amount of principal you owe the bank is getting lower over time. If the customer asks you, how much money do I still owe the bank after 10 years? So we can refer to month 120. All right. After 10 years, the outstanding amount is 329 over 1,000. Back to my question just now, how much salary do I need to have in order to afford the loan? Well, most bank criteria is 1/3 of your monthly income can be used to pay back the monthly installment. So I just need to take the monthly installment times 3. Roughly, you need to have an income of 6,738 in order to be qualified for this loan. Another interesting question is, have you ever wondered how much interest the bank earns from you for a 400,000 loan over 30 years? Well, I did a quick summation at the end of the spreadsheet, and here is the answer. The interest charged by the bank is 408,000, and you actually pay 808,000 installment in total, more than double of your original loan amount of 400,000. So, save more money before you buy a property. Reduce on the loan amount and loan tenor as much as you can, because the compounding effect of interest is huge over time. I hope you truly enjoyed this session. Thank you.